Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and in investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this program on whatever platform you happen to be using. Well, the market staged a significant rally from those early April lows, but will this move higher continue? And what issues may be on the horizon? That is just some of what we'll discuss in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Carrie Coghill of Coghill Investment Strategies in Pittsburgh, Frank Rossetti of HF Management Company, Kim Forrest of Boca Capital Partners, and Michael Godwin of Fergasso Advisors. It's been a while since we've had a chance to talk, so it's good to see all of you again. You know, in the last month, the three major indices have all had significant gains, and all three, as of the close on Tuesday, May the 20th, they were basically break even for the year. That rebound from the early lows that were set in early April, I should say, it's very impressive. But what does this tell us? Is this a continuation of the bull market, or is this just a reaction over, or overreaction maybe even, to the latest comments on social media or postings by the Trump administration? If that is the case, does one just close his or her eyes and ears and just pay no attention to what is going on? Well, when the market dropped in April, all of you said, hold the course, steer into the storm, jettison some holdings for tax purposes, find some good buys, but don't abandon the ship. Well, if your clients listen to you, they must be very happy right now. So, Carrie, continuing with this ship analogy, if you're in the crow's nest right now, what are you looking for?
Well, I think that we're entering a time of transition, transitioning from one set of problems to a new set of problems. And I know we'll probably get to this later when we talk about treasury yields, which is, now our new set of problems. But the reality is, in terms of the stock market recovering, the data really never broke down. So yes, there was a lot of noise. And one of the reasons why I think most of us on this call did provide the suggestion that to ride through it was because we weren't really seeing significant breakdown in the data. You had some data points that maybe were weak and other data points that were strong. But the one thing I do want to point out in this is that the comment you made about, taxes and making changes during volatile times for tax purposes. What I can tell you is our clients are very happy with us right now because we didn't just wait. We looked for opportunities to tax loss harvest. And when I say we weren't out of the market for 5 minutes, I mean it, because in the last couple months, you couldn't be. So we were literally swapping positions if we had tax losses, going from one stock within a sector to another stock within a sector, at the same time doing that swap, capturing a tax loss, but not allowing our clients to be out of the market so they didn't miss that recovery. So, I think that as we move forward, there are a lot of good opportunities still out there. We have seen the Mag 7 really jump here, mostly in the last month. But as we look to the future and look at the opportunities within certain sectors, it's not too late to continue to go shopping.
I completely agree with you, Carrie, on everything. And I think that just shows you that, we were right. We get to do the victory lap. It's so rare, right? And especially in such a short time when we say stay the course. Probably since 2010. You have been a fool if you got out of the market and stayed out of the market. And you're probably still sitting in cash. You felt great when it happened, but this is not a lesson that anyone should learn. So don't ever do that. Go to cash unless you need the cash for something, to buy something, but that's neither here nor there. Anyhow, I'm drifting off. But I also have to say, I agree with your bias that the future is still going to be better. Everything is always changing. It's just changing very, very slowly. And the markets kind of drift in that way. They reward outperformance. So even though some stocks that you may have loved for a very long time aren't doing well, others are going to rise up and replace them. And that's kind of what you have to remember as a market participant is there's always change and turmoil going on regardless of the headlines. It could be smooth sailing, but things are changing just very, very slowly.
All that being said, the idea of moving to the rising stars, if you will, is very difficult to do. This is why indexing makes a lot of sense. If you have an index, whether it's an industry or the general market, as the rising stars happen, because you can't, in quantum computing, which is probably the next big thing, who knows which one to pick, and it's probably 10 years away. Kim says you know which ones to pick, Kim, right? I don't. But if you're in an index that focuses on something like that for the long term, this isn't for somebody who needs the money in a couple of years, because this is probably maybe a 10-year event, 20 years before it's the gorilla in the room, maybe 30, who knows. The point is, indexing takes away the need to try to figure out who's coming next. It will take over the index as well, and the index will perform accordingly.
I think it is nice to be able to pat yourself on the back and say, I got something right, which, it might not happen as often as we like to in this industry for sure. But I think we did talk about, stick your head in the sand when those tariff announcements came out, and then pick your head back up when it's all said and done. What's interesting now is it's sort of like we have a new set of problems on our hand, I think. I mean, obviously, when the market sold off close to 20% in very, very short order, almost like COVID time, the problem there was how do we keep clients invested? What do we do kind of next? Now that the market's pretty much fully recovered, close to new all-time highs, it's a new set of problems, I think. I mean, the market isn't cheap. There is a ton of uncertainty on here. Tariffs are, even though they've temporarily come down, whatever you want to call it, the new effective rate is higher than it was certainly at the beginning of the year. So that leads me to believe that we're still going to have quite a bit of volatility, I think, in the back half of the year. We'll talk about debt problems, I'm sure. Carrie mentioned the rates moving up earlier, but that's going to be an issue coming down the line. And then in regards to the data, I mean, Carrie's right in a sense regarding the data is not that bad. That's the hard data, right? The soft data doesn't look so good. Soft data it can be wildly volatile. That's usually surveys, consumer sentiment. Consumer sentiment is terrible. CEO sentiment is not very good right now. If that progresses into the hard data, that could be something that's worth paying attention to. Walmart came out recently saying we have to raise prices. Target just came out today saying things aren't looking that great. We need to raise prices a bit more too. Consumer spending is slowing down. So if this is sort of like anything in the economic environment, a vicious cycle, that would be something that I want to be mindful of and pay attention to in regards to how that can transpire into the stock market, and we could see another leg down in equities.
The great thing, though, Michael, is that many CEOs aren't just looking at consumer confidence. They can see in their pipelines. And that's what I have great confidence in. And I think in the past, CEOs might have pulled the trigger faster, looking at the national data, right, both soft and hard. So whenever they saw that consumer confidence was waning, maybe they wouldn't stock the shelves. But the great thing is, well, maybe retail isn't the thing that we should look at, but further out in the supply chain, those companies really can see what their demand is. And I think that is a buffering effect that investors really haven't gotten used to, is that data that we can't see, but the CEOs can, that's the thing that's driving their decisions. So the consumer used to throw companies into a fit saying, oh, they're slowing down. But I think that in-house data really saves companies from chopping off growth potential too early.
Yeah, and it's not lost on me that the CEOs will use this tariff regime thing as an excuse to reset expectations a little bit lower. Hey, it's not my fault this happened. That's not lost on me, but it's still all data points that we need to be very, very mindful of, I think.
Also,
This, I think, really goes right into the next question I had, and that is, of course, the last time we met, we talked briefly about European stocks. And J.P. Morgan this week said it sees a record outperformance by European stocks, and they think the S&P 500 is going to slide. In fact, for the year, according to Bloomberg, the stocks Europe 600 index is outperforming the S&P 500 by roughly 7 percentage points. So, Michael, how much consideration should an investor really be giving to investing in European stocks at this moment?
A bit, I think. I mean, well, I could take this in a number of different ways, Stacy. So, I wholeheartedly believe in diversification. I always kind of will. If you're trying to build a long-term, robust portfolio, I will believe in that. You're getting to a point, I believe, where in a traditional 60-40 model, whatever, bonds are not quite the diversifier we always thought they were, or they were over the past 15, 20 years. And you're starting to need to find pockets of areas, whether it's in, we could talk about privates, I'm a believer in privates, privates or small cap, mid cap, but even international stocks to help diversify your large cap, US large cap exposure here. We've been talking about international stocks in this program for a number of years now. We like them from a valuation. We thought they required an exposure to the portfolio based on valuations, based on diversification, based on geographical situations, etc. And you're seeing that play out this year, Stacy, in terms of the performance disparity between finally U.S. stocks and international stocks. So in our portfolios, we hold an allocation to the international markets. We are underweight that from a global benchmark standpoint. I think investors should probably be structurally underweight European stocks in a portfolio for, I think, the long haul. I think they have problems from a demographic standpoint. I think they're a very fragmented continent, meaning, what people like in Spain, they don't like in France, they don't like in Germany, etc. And I think they're eons behind in terms of the growth areas of the market, really technology. They are, when you're trying to start a new technology company in Europe, the amount of red tape there and the regulatory hurdles to do that is mind-blowing to me. It is so much easier to do that in Silicon Valley than it is in Europe. And to be honest with you, Kim will probably tell you this too, the growth engine of the world from a stock market standpoint is technology and communication services. And they are so far behind in that area of business that it's going to be hard for them, in my mind, to play catch up and actually have a sustained outperformance over the U.S. over the long haul. Yeah, you'll have pockets like we have this year, maybe even next year, but I would remain structurally underweight there, but still have an exposure there because, one, you need it from a diversification standpoint, and two, there are good companies over there that you want exposure to over the long haul. You don't want to be just tied to the top 10 stocks in the U.S. here, like the S&P 500 pretty much is right now.
So my take's a little bit different. We really have, when you look at using international in a portfolio, you have to look at it from a diversification perspective. And to give you a history of how we've approached it, we've been out of it until earlier this year, and I'll give you the reasons why. We've been out of international for the most part. And the reason for that really has to do with globalization. If you go back and you look at the 70s and the 80s, the reason to diversify is so that you have something in your portfolio that can perform when other things aren't. You don't want correlation. You don't want things going up and down at the same time. So international was a great diversifier until globalization took off. In the 90s, 2000s, what happened was the benefit of diversification didn't really matter, that the US and Europe and other internationals were working in sync. And so to the point of the US being the growth engine, technology, all of that, we asked ourselves the question, well, why even own Europe? So we didn't. We got out of it. What has transpired since then is that the world is finally, we've used this word a lot in the past, but we are finally starting to see the world decouple. The US is, we're all becoming protectionists, and Europe is finally waking up to the fact that they can't ride on the US's coattails. They've got to figure out a way to make their economies work, to work within themselves. They're working directly with China. I mean, there are opportunities there. So that's a reason why earlier this year we decided to add an appropriate allocation back. This is not an either or. This is an addition in diversifying our equity exposure, keeping our US exposure, but just allocating a portion of it into international. The issue of technology and growth and companies here, yes, absolutely. And international companies, as Michael was just saying, there are really good companies there. The valuations have been low. So we know what we're getting. We're never going to compare an international fund or even an international growth fund to a US growth fund. I think you're probably going to get better performance out of the US. But from a diversification, smoothing results, helping clients not look at their portfolio and see wild swings, international may now be a good contributor to smoothing that performance.
Would you do what Michael is talking about, though, and keep it underweight as such?
Well, it depends on what you're underweighting it to. I mean, we look at when you determine an allocation, there's a process that we go through called portfolio optimization, which means when you add a sector into a portfolio with a certain makeup in terms of risk return, at what point are you actually reducing your risk and increasing your return versus adding too much risk? So I think probably right now, if you're looking at allocations to international within your equity sleeve, most people are, that I see anyway, are somewhere between, 15 and 20%, 20% on the high end. So it's all relative to, underweight to what, right?
Okay.
And if you add to it right now, we've had, until recently, a nice run in the dollar. It's gotten very high. And if the current events cause the dollar to weaken, which they may, when you sell your Sony or your Siemens or whatever your foreign company is or foreign mutual fund, you'll get more dollars for it if the dollar weakens. So there's a currency play in there as well currently. But the 15, 20% number, Carrie, I tend to think is one that makes sense, because you have to also remember with your multinational companies, McDonald's, I think, does 60% of their sales outside of the United States. It's an international company, and many of them are. Boeing just got big orders from somewhere in the Middle East. And these are international plays. So you have more international than just owning the international fund.
And to wrap up, I have not a whole lot to say here because my mandate is U.S. traded stocks, so that kind of limits me. But I agree with a lot of what's being said around here. Mostly Michael and I are lining up with the regulatory environment, and God knows the demographic environment of Europe just doesn't look good for a long-term hold, which is what we generally tend to do. But most of the companies that we own have some exposure to all around the world, because if they're a smaller company, they're a niche player providing things that nobody else makes. And while I think decoupling is largely happening, I don't know that we're going to go back to even the 90s with respect to the level of which goods and services were in a home country. But I do think that especially things having to do with military applications, health applications, that a lot of that is going to be diversified away from a single source country for sure. And it's just prudent for companies to have more than one source for their inputs. So
one final question on this, if I can, and that is, if someone wanted, and they're not, let's just say they're not invested in any European companies or stocks right now, are there ETFs on the European side that you can buy similar for different sectors that you might think the European stocks would be doing better on?
Yes.
Okay, good. They can find that on their own. We won't make any suggestions on that. Last week, Moody's downgraded the U.S. credit rating, citing large fiscal deficits and rising interest costs. And yesterday, pension funds in Hong Kong said they might have to begin selling U.S. Treasury holdings. So, Frank, how significant is the credit rating and whether entities do begin to sell the U.S. Treasuries?
Well, this is the third of three downgrades. Standard & Poor and Fitch downgraded years ago, I think, quite a while back. Moody had just joined the club, if you will. I personally think it's a symbolic thing. I have a hard time believing that the US dollar is not the primary currency in the world. If it isn't, please tell me which one is. And we have a size of market and a robustness that no one else has. The euro has tried, but we've all heard the problems with Europe, and that's going to affect that currency. We've just discussed them. So I think that act is minor. I think the deglobalization, decoupling, whatever you want to call it, is a bigger deal. I think that the potential of war is a bigger deal. I think all of these things are a bigger deal than that. I think we've got a lot of stuff out there that just is going to create volatility. And for we who are long-term investors, volatility is a difficult thing. Traders, if they're good at it, they can do it. I tried that back in the 70s. I wasn't any good at it.
Okay.
Yeah, so I think it's I'm not surprised this is becoming an issue because it is an issue. And, when a pension fund or these institutions that are managing money have investment policy statements, there are stipulations as to the quality of the debt that they can own. So when a pension fund comes out and says, oh, we might have to sell, the reason for that would be if it fell below whatever the mandate is in terms of the quality of credit that they can own. So, I think that it's kind of a warning that if we were to continue to see downgrades on U.S. debt, that you could find yourself in a situation if more declines come, that you might see some forced selling with those institutions. I don't think that we're there yet, but watching yields and, the issue with the yields, and you go back and you look at other timeframes, right? We always talk about, okay, what other timeframes were we faced with similar situations? And, we've had crisis, a debt crisis like this in the more recent history. We had, Greece, we've had Argentina. If you can even go back to 2011 and look at the debt ceiling fight that occurred. So we really have to watch what happens in Washington. We really have to monitor what's going on with the deficit to understand, what challenges we might have as bond investors with yields going up, but also what impact that might have with stocks, because obviously higher financing costs lead to a slower economy. So, is there potentially an overreaction? Potentially. I would think that there's kind of this knee-jerk reaction right now, but I do think it's something that we all need to continue to keep our eyes on.
It's funny, I don't really think there's been a reaction this time around. I remember in 2011, Frank, when the S&P downgraded us, that was a big deal then, and the market really took it like that. But maybe it's not. I don't know if I should be surprised or not, but the market seems to have kind of shrugged it off a little bit. This downgrade by Moody's, and to your point, maybe it's because it's the third leg. Finally, Moody's came around and downgraded us a bit. I think Carrie is certainly right with everything there she said, though. The debt has been a problem in this country before I was born. People have been talking about this. When's it going to come? And I certainly don't like the way we're headed right now. I mean, we're just continuing to pile onto it with zero regard for it. And Frank, to your point, yeah, we're going to be the reserve currency of the world for a while. That's going to, at some point, that will end. I mean, all I don't want to say nations fail, but there's always a regime shift at some point, and hopefully it's long down the line here. But with higher rates, this is going to beget higher rates for sure. Rates are going to stay higher. And we came out of a period in COVID where rates were zero. Companies borrowed at nothing. And that refinancing wall is going to be coming down the pike pretty soon. And to Carrie's point, needing to refinance at levels that are significantly higher than when you initially took out the debt could be a problem. I'm hoping it's just hyperbole right now that I'm spitting out, but it could be a problem down the line here, because it is remarkable that we went through an era where there was 0% interest rates, the economy was doing very well, but still, Kim, you might know this, how many companies in the Russell 2000 have negative earnings? I think it's like a third of them still have negative earnings. You're going to need to refinance debt at levels that are significantly higher. You just hope that doesn't, again, spin out of control at some point.
So I just want to interject real quickly here. There's a great, to Michael's point, a great Time magazine cover that has Uncle Sam on it, holding his hands like this saying, "Is the U.S. going broke?" That magazine cover was from 1972. So it has been
Yeah,
a long
before I was born. There we go.
See?
Michael, that was my first year in the business.
Attaboy, Frank.
First full
And you made it. You made it all this way. Good.
So my question then, to follow up on our discussion here, and that is that what is the impact of these pensions or whoever else, even countries, selling the U.S. Treasuries, getting out? Is that?
Well, I just have to make a point here. Where was the pension that was talking about this domiciled?
Hong Kong.
What?
Hong Kong.
Hong Kong. And is Hong Kong the independent place it used to be? No. I think that was more of a shot over the bow from the Politburo of China, kind of tweaking our nose. Now, I do agree that investment committees have to abide by their charter. And if we get downgraded another notch, they're going to have to look at that. Albeit, if the United States can't pay its debts, we've got more problems than, like, the fallout from that is going to be a different world than we're living in right now. So I don't know that I'm terribly worried about that. And just a thing that I always do, I love reading the op-ed pages of every newspaper, and I always look to see who wrote it before I read it, because I know everyone talks their book. And if I hear a pension from China is saying, "Ooh, we're going to have to stop buying bonds," I know who's really doing the talking there.
Okay, fair point. Very good point.
And let me add one other thing to it.
Sure.
In my world, private equity and real estate world, we're beginning to see that refinancing wall. The 5-year refi on real estate loans and other commercial loans have begun, and it's impacting negatively the projects that we're involved with. And that's simply because 5 years ago interest rates were zero, and they're not anymore. And for those people that were over leveraged, it's a big problem. For those people who were conservative on a leverage, they can deal with it.
What's the average rate would you say you're seeing right now on these refinancing?
Well, they're refinancing in the 6.5, 7 range now, up from 2 and 3. It's a big deal.
That is a big deal. You're right. As you all know, Warren Buffett is stepping down. So, Kim, I saved this one for you. Is it really that difficult to do what he has done? Oh, just a measly gain of 5,500,000% on his stock, Berkshire stock, since he started.
Well, a couple of things. I think he has a great track record, of course, and he's a great investor, no doubt. But two things. Timing is everything. He entered the business at a great time, and he did some very unconventional things. I pose to you, if you're somebody who only has the ability to trade stocks in your portfolio, you are not going to be able to match him. And it's not because you're not some sort of genius. What he really has is kind of a half-breed between private equity and publicly traded stocks. So, because he has bought outright entire firms over time. The other thing that he has done is he has not tried to outperform the market within the year, every year, in and out. And I think that will trip you up in the long haul if you are really trying to go for that arbitrary year-over-year performance. He has a longer time view. And I think those are some things that you could take away. You're not going to be a private equity guy unless you are a private equity guy. You know what I mean. But I think the magic of compound interest is showing up in his long-term patience for companies like Coca-Cola. And he held on to that even during the dot-com, didn't chase dot-coms. He knows what he knows, and he applied it. So investors, take some lessons from Warren Buffett.
Yeah,
And
I
if
think
you
that
want to read the playbook on that,
yeah.
pull up The Intelligent Investor, written by Graham. I can't remember his first name right now. I'm drawing a blank.
Benjamin.
What's that?
Ben Graham.
There you go. And read it, because that's the playbook on what Warren Buffett did.
Yeah. I will say that the one thing that Warren Buffett has complete control over that most people don't is his emotions. And, I think, as time went on, right, and he accumulated more wealth, the more wealth you have, the more patience you also can have.
Sure, yeah. Michael, any comments on him?
I mean, the guy's a legend. I mean, he and Charlie Munger, you can't. Good luck to replicate him. It's going to be impossible to do. It's like saying, I play soccer. I'm going to be like Messi. It's just, it's tough.
Yeah.
A tough feat to accomplish. So,
Right.
Kudos to those early investors. Kudos to him.
Yeah. I think he even says that for the average investor out there, which maybe just have their 401k or whatever, stick with the ETFs figure out which ones are the best ones and then try to go with those. So I don't know if you guys agree with that advice or not, but that was what he said in one of his parting comments, I think. So
Certainly don't disagree with it. The problem is there's a million ETFs out there now.
that's true.
There's more
Very true.
ETFs than there are common stocks, I think.
Yeah.
There might very well be, and even more come up every day, it seems like. All right, thank you so much for joining us. We will continue our look at investing in the economy and our future sessions. And since you're watching or listening to this particular program, I ask that you hit the subscribe or the like button on whatever platform you happen to be using. But for right now, thank you again for joining us, and we'll see you again in about 2 weeks or so.